According to the Bank of England, the rising cost of living, caused mainly due to the inflation that we're seeing at the moment, will push the United Kingdom into a recession in the coming months. While we aren't technically in a recession yet, there are definitely some tricks that you need to know if we do fall into one. So it's always best to prepare yourself ahead of time and know exactly what your game plan is going to be when the likely inevitable does happen. Today, I'm going to give you 10 quick fire tips that you can use in your own investing planning to make sure that you're prepared for whatever is around the corner. The most recent recession we've had in the United Kingdom was also its shortest, and that was between April and June of 2020, when the GDP shrank by 20% in that very short period of time. Due to these unprecedented circumstances, there are people out there who argue that you can't really class that as a real recession because it was so short-lived and it was kind of synthetically produced for obvious reasons. But prior to that, between 2008 and 2009, there were 5 quarters or 15 months of recession because of the global financial and banking crisis. The impact of recession can be disastrous, with it affecting people's earnings and people's job security. That said, the UK's unemployment rate is currently sat at historic lows at just 3.5%. Now, you've got to go all the way back to 1973 to find a time when unemployment in the United Kingdom was lower. Even more interestingly, unemployment rates have actually fallen over the last 2 years since we came out of COVID lockdowns. So that would tend to suggest that perhaps we're not going to go for a recession. So who really knows? Either way, it's always best to be prepared. And if a recession is around the corner, we're all going to be in for a very rocky ride. Therefore, to help you through what could potentially be a very challenging time for any investor, let alone somebody who's completely new to this investing world, I've pulled together 10 investing tips from various places online and from videos that I've seen that hopefully will help you continue to do what you're planning to do no matter what happens in the market. Tip number 1 goes without saying, and it's to diversify and spread your risk. Diversification is absolutely key for any investor, using a mixture of asset classes including stocks, bonds, cash, crypto, property, amongst a number of other different options. Now, depending on how old you are, your investing horizon, what you're investing in, and how much you like to take risks will depend on the exact makeup and weighting of your own portfolio. For example, I currently invest in low-cost ETFs, individual stocks, and cryptocurrency, and I don't actually hold any bonds or any property within my portfolio. You could definitely argue that some of the REITs that I hold do give me exposure to property, but I definitely don't hold any bonds, and that's A, because I'm still fairly young and it's not something that I see as needed in my portfolio, and B, because of the more that I read, the more I understand that actually investing in 100% stocks, whilst it's more volatile and more risky, can still prepare you as well for retirement and into retirement as any other strategy. That said, it is absolutely key to not put all of your money into one company, or definitely not just one crypto. Use of ETFs and index funds already diversifies your portfolio massively anyway. So as long as that makes up a fairly large percentage of your portfolio, you're already a step ahead of most people out there. Spreading money across different geographical regions is also a great strategy, just in case there's an economic downturn within a certain part of the world. You're going to be covered because you're investing in other areas as well. The key here is to make sure that whatever you're investing in, you're happy with your risk profile, and that is essentially how much risk you're willing to take. If you can't stomach 50% pullbacks, 25% pullbacks, or potentially worse if we do see a really, really bad recession, then you probably shouldn't have 100% exposure to equities. And perhaps you need to consider what other assets you could include. The key take home here is to not put all of your eggs in one basket. Tip number 2 is to drip feed money into your investments, or otherwise better known as pound cost averaging. It's very difficult to time the market anyway, but during recession and times of uncertainty, the market can do some fairly odd things. So it could pull back well over 4%, or it could climb well over 3% within a few hours. So trying to time the market is a bit of a fool's game. By trying to time the market, you're essentially trying to beat the market, which even institutional investors with massive hedge funds can't really do anyway. So it's probably not a good idea for us to try it. It's best just to stick to your normal investing approach, which is to invest a set amount of money every single month, no matter what is going on. Now, I personally do invest more throughout certain periods. For example, if I see a 4 or 5% decline, I might find another few £100s to put into the market. But that's not me trying to time the market, that's me just taking additional advantage of a dip that I have seen. I'd still continue to put in the rest of the capital that I would normally have done, but that's just another opportunity for me to buy in at what I would see as a lower than expected price. And if the market does continue to decline, it's no big deal. It just means that you're continuing to pound cost average in at a lower price, meaning you're averaging down your average unit price. In the long run, this is shown to be one of the best approaches that you can take throughout a recession or market downturn. Tip number 3 is to take advantage of cheap stocks. Now that does kind of fly in the face of the advice that I just gave of not timing the market, but let me explain. When people try to time the market, they essentially try to hoard cash behind until they see the best moment to hop in. By taking advantage of cheap stocks or ETFs, what you're essentially doing is investing more cash than you would normally have done when you spot yourself a bargain. That links back to the point that I just made. If I see something fall 3, 4, 5% in a day, I might decide to put a little bit of extra cash into that investment because otherwise I'd have just spent it on something else. So I might move cash from something else that I've budgeted for into my investments to take maximum advantage of that pullback. Still continuing to invest and pound cost average in, but just putting a little bit of extra capital in at a decent time. Tip number 4 is something that I'm really big on, and I think most of my viewers are as well, and that is keeping your costs low. This isn't referring to sitting in your house and hermiting all the time throughout the full recession. It's essentially saying to keep the costs and fees attached to your investment products as low as possible. On most platforms, there are fees for holding your investments there. For example, Vanguard has a 0.15% account fee in addition to any ongoing charges fee of the products that you invest in. Places like Trading 212, Free Trade, and Invest Engine for that matter don't charge the account fee. So maybe throughout periods of recession, you could go and look at those platforms as well. But personally, Vanguard's the one for me. The average cost of the investment ETFs that I hold at the moment are between 0.07% and 0.22%. But you can find investment products out there that charge well over 1% in ongoing charge fee just for holding them. Now these are usually active funds out there which have a fund manager, but why not just invest in a passive index fund for a far cheaper price? If 2 people decided to invest £300 per month for 30 years with an annual rate of return of just 7%, yet one of these people was paying 0.5% in fees and the other person was paying just the normal amount in fees, the person who was paying the normal amount in fees would end up with £34,000 more capital at the end of their investing journey. So it shows that just 0.5% can make a 5-figure difference, and not a small 5-figure difference at that. So watch your fees. Tip number 5 is to invest in a ready-made portfolio, an index fund, or something like a life strategy on the Vanguard platform. This will make sure that your investments are balanced throughout a challenging financial period, and you can also include bonds and different types of assets within your overall portfolio. This essentially means less work for you, security, and probably a reduced risk as well than doing it on your own. Using the life strategy suite of funds, for example, you can choose a mixture of stocks and bonds dependent on your own risk appetite, which means that you have complete control over where your money goes, but it means you've not got to do any of the hard legwork behind the scenes to make sure you know where your money is going in a safe way. Tip number 6 is to never invest in something that you don't fully understand. The best thing you can do is not try to chase that company which looks too good to be true. Particularly through times of economic downturn, investing in large blue chip common companies is probably the safest thing that you can do. Companies like Coca-Cola, which have weathered economic downturns before, will surely be there for the long term. Tip number 7 is to consider safe and novel places to put your money. We've already talked about diversification, but have you thought of putting your money into a high yield savings account, buying precious metals, investing in bonds, or potentially peer-to-peer lending? Now, I'm not saying that those are the right things for you to do. I actually don't invest in any of these myself, but it's definitely something to consider. Historically, gold has been a very good hedge against inflation and also recessions for that matter. So it might be worth putting a little bit of money into precious metals throughout this period of time for security. Tip number 8 is to not sell your dividend paying companies, even if they do cut their dividend. Throughout a recession, companies are going to go through a challenging period of time, much like everybody else's finances at the moment. So sometimes companies do stop paying their dividend to protect the interests of the wider company and protect your capital investment as well. We saw this happen throughout the COVID pandemic. Lots of different companies did cut or completely stop their dividend whilst there was that period of uncertainty. But most of them, if not all of them, have now restarted it. And dividends have continued to grow since that period of time as well. Just because a company stops their dividend doesn't mean that the company is no longer worthwhile investing in. So it's always worth doing a little bit of a deeper dig to have a look at exactly why the company has stopped that dividend so that you can make a more informed decision. If you hear that a company has stopped it, don't just sell them, because they may well restart that dividend a few months later and there may well be a good reason for them doing it. Knowledge is power, so don't make a decision without fully understanding what you're doing. Tip number 9 is don't panic. When markets are falling, it's very easy to make knee-jerk reactions and to make decisions using emotion rather than logic. Selling your investments at a hefty loss can be one of the worst things that you do throughout an economic downturn, and perhaps actually investing more capital during that time will make you more prosperous in the future. If you do sell after the fall, you'll miss out on the recovery, which often yields some of the best returns on investment that anyone can ever expect to see. Uncertainty over the cost of living crisis will continue to cause market volatility. So the key is to focus on your long-term goals. You've started investing for a reason, so let's continue to do that and take maximum advantage of the time ahead of us. And tip number 10 is to take comfort in the past. No matter what has happened historically, we've always come out the other side better, stronger, and more wealthy. If you have an investment horizon of over 5 years or definitely 10 years, then you can guarantee historically that you'll finish off in a better position than you would have been if you'd sold out and got yourself out of the market. Time in the market really is better than timing the market, and that is essentially what history shows us, and my own investment account for that matter. So why not check out exactly how much my Vanguard account is worth at this moment in time, or if you prefer to see a little bit more on recessions, why not check out this video showing why recession isn't necessarily the worst thing that could happen.